All right. Welcome. Thank you for joining us for the Connecticut Affordable Housing Conference. I am Chelsea Ross, Deputy Director at the Partnership for Strong Communities, and Sean Guillot, Senior Policy Advisor, is here as well. The CAHC features local, state, and national experts that lead conversations that explore challenges, share best practices, and coalesce us around critical next steps to address key affordable housing issues in our state. This year, the CAHC is focused on building stability, and each session spotlights a unique approach to strengthening housing stability for households and communities across Connecticut. This session is entitled A Rundown of Connecticut's Current Housing Market. Before we turn it over to our presenters, we'd like to thank our leading sponsors, the Connecticut Department of Housing, the Connecticut Housing Finance Authority, the Rosa Building Group, the Melville Charitable Trust, and Wells Fargo. Their deep support has allowed the conference to happen again this year. Thank you to our collaborating sponsors. And we have an armful of supporting sponsors that have helped make this conference happen, so thank you very much. Last but not least, a big thank you to the sponsor for this session, Citizens Bank. And a quick announcement that Partnership for Strong Communities housing data profiles are updated. You can access the latest housing data for all of Connecticut's towns and cities in an online interactive format. Each housing data profile contains a summary of important housing data in each town. You can get the fast facts on affordable housing or do a deep dive on the distribution of your city's housing costs. I'll add a link to those housing data profiles in the chat in just a second. A few housekeeping items before we get started. The session is being recorded and we'll make all recordings available as soon as possible. All participants have entered muted. Please remain on mute unless a speaker has asked you to unmute. If you have a technology issue, please select the chat icon in the Zoom control panel and send it in the chat to myself, Chelsea Ross. I will do my best to assist you. Your speakers will let you know how they would like content questions to be submitted. And with that, I will now turn it over to Sean Guillot to get us started. Sean.
Thank you, Chelsea. Good morning, everyone. As Chelsea mentioned, I'm Sean Guillot, Senior Policy Advisor at the Partnership for Strong Communities, and I'm really excited for this event, opening up the conference first session. We have some really great speakers, so let's get to them quickly. First, I want to tell you a little bit about the team, where the team comes to us from. They're with the Connecticut Housing Finance Authority, which is a self-funded quasi-public agency. Its mission is to alleviate the shortage of affordable housing throughout Connecticut. So CHFA is Connecticut's low-income housing tax credit allocator and provides financing through a variety of mortgage programs for first-time home buyers and for developers of affordable multifamily rental housing properties. So CHFA seeks to be an innovator in its work, and it's driven by service through collaboration with partner organizations in the community at large. Partnership for Strong Communities, we're lucky that we work very closely with CHFA research team and a lot of others over there. They are very collaborative. So to meet its mission, CHFA's research, marketing, and outreach team supports the work of the authority by providing research and data that inform decision making, strategic planning across each department. The team also provides regular housing market analysis that's available to the public through its housing briefs, blog posts, and online dashboards. I really recommend folks check out their website, look for the research team's website. There's really an amazing amount of research and data available to you. So at this point, I'm going to send it over to Jonathan Cabral from CHFA.
Thank you, Sean. Thank you. Good morning. Thanks to the partnership for having us. This is an event I always look forward to, and I've been able to participate last couple of years, and I've always looked forward to it. So thanks for having us. So I'll introduce myself. My name is John Cabral. I'm a manager at CHFA, and I work in the Research, Marketing, and Outreach Department. I've been at CHFA for now about 11 years in different capacities, but my love is doing sort of the research around housing and working with the team on providing data and research on what's going on in Connecticut, particularly around housing, the spectrum of housing. So before we kick it off with our presentation, I wanted to pass it on to my colleagues so they can introduce themselves. So Andrew, why don't you go ahead?
Sure. Good morning, everyone. My name is Andrew Bolger. I'm a senior research and data analyst with CHFA on our research, marketing, and outreach team. I've been with CHFA, this will be my 5th year. And in short, my role is really tracking kind of market conditions, which you'll see here today, and evaluating CHFA's programs and impact. So, Kayla.
Good morning, everyone. I'm Kayla Giordano. I'm a senior program and data analyst in the research, marketing, and outreach department here at CHFA. I wear many of the same hats as Andrew: housing market trends, program evaluation, data analytics, to really help understand what's going on in Connecticut, as well as how CHFA's programs are impacting low-income families.
John,
Great.
before you get started, I failed to mention, as we go forward, if folks have questions, please enter them into the chat. I'll try to moderate them. We're going to have some discussion at the end of the presentation, and I may interject as we move forward with some questions as well. So back to you, John.
Awesome. Thanks, Sean. Great. So Andrew, just get up. There we go. Perfect. All right. So I want to sort of kick it off, of course, by thinking of the partnership and also sort of introducing CHFA. I know Sean sort of introduced CHFA already, but we're a quasi-state agency, and we were established back in 1969. While we work very closely with the state and established by statute, we are a quasi-state, quasi-public agency. So we don't take or rely on state appropriations. However, we do work really closely with Department of Housing and a number of partners on trying to provide and alleviate the shortage of affordable housing in the state, which is our mission. And as Sean described, we do it in 2 different ways. We do it by providing the low-income housing tax credit program, and through providing mortgages to developers to rehab and build affordable rental housing, again, throughout the whole state. And then we also do it through our single-family program, primarily through providing single-family mortgages, homeownership mortgages, to folks who are looking to purchase their first home, which is a wonderful program and a wonderful way of families establishing wealth and investing in their community. CHFA has originated or purchased a mortgage in every town and city in Connecticut since its inception. That comes up to about 147,000 mortgages statewide. Next slide. Cool. So one of the things that we have done over the number of years, but which I think is interesting and something we love to share, is we provide housing needs assessment for the state. So we did a housing needs assessment back a few years ago, where we looked at what the shortfall was in housing in Connecticut, and we found that there was a number of things that probably isn't surprising to anyone who's attending this conference, and that there's a demand for there's a lack of supply, and there's demand for homeownership stock for those earning 50 to 80% AMI, and really the fact that generally folks who are earning 30% AMI and below are fairly cost burdened, particularly on the rental side. And about half of the renters, and about half of the renters are cost burdened, quarter of renters are severely cost burdened. So they're paying over 50% of their income on housing. The state is slated to have a number of affordable units expire in the next 10 years. So affordability on the rental market is something that we take seriously and something we're trying to solve, again, at CHFA with the Department of Housing and with a number of partners. There are other housing needs assessments that were done for the state. Department of Housing conducted its own, and it had very similar findings as CHFA's. In fact, DOH's housing needs assessment stated that there's about a shortage of 86,000 units statewide, and our housing needs assessment kind of had a similar number, and other reports have come in about that 80 to 90,000 unit shortfall. And one of the things I find most interesting is that there's a mismatch of rental units with AMI, folks who are earning certain incomes. And so there really is a need for more housing across the whole spectrum in Connecticut, but again, particularly for those earning 30% of AMI or below. Before we kick it off and before I pass it on, we are planning on updating our housing needs assessment. Andrew and Kayla are working diligently to do that now, and hopefully we'll have an update to that needs assessment in the first quarter of 2023. So I'll pass it on to, I think it's you, Kayla.
Yep, thanks, John. So before we really get into what's been happening most recently in the housing market, we kind of want to set the scene, give a little update on what the demographic information in Connecticut looks like. So here on the screen is going to be a really important slide. And this shows both the change in population in the state by county, as well as the change in the number of households. And as you can see, with the exception of Fairfield County, Connecticut has been losing population consistently between 2015 and 2020. However, our number of households has actually grown in the state. So what it comes down to when we're looking at household growth is simply when someone moves from one residence to another. So a great example I always want to bring up when we're talking about household growth is a young college graduate moving from their parents' house into their own apartment. That represents a growth in one household. So when we see household growth, we see increased demand in the supply of housing. So that's going to be important as we kind of look at what's been going on in the past couple of years. Here we take a look at Connecticut's population distribution by age. And the big takeaway from this graph is that Connecticut's population is much older than the US is at large. So here you'll see Connecticut is represented by the green bar. So there's a big concentration, towards the right there, Gen X and boomers. And the US has a much higher population of the younger generation. So millennials, Gen Z, even Gen Alpha, those really young residents in the US. So taking a look at occupancy type by age in Connecticut, this looks at ownership rates and rental rates. So it makes sense that the rental rate is much higher the younger the person is. So those 20 through about 30 has a much higher rate of renting, whereas homeownership is much lower. However, in Connecticut, which is represented on this graph, we see those lines start to converge around 33 years, 34 years of age. That's when the homeownership rate really starts to take off. And Connecticut's homeownership age of around 33 or 34 is actually a couple years lower than the US average, which is around 36. So there is some evidence that residents in Connecticut achieve homeownership at a younger age. Taking a look at homeownership rates in Connecticut versus the United States, we see that historically Connecticut's ownership rate has been higher than the national average, except as we get to a little more recent years. And this makes sense given the competitiveness of the home buying market in 2020, 2021, just made home ownership a little harder to access. And so it's brought that home ownership level in the state a little closer to what we're seeing nationally. But what's really interesting is when we break down this home ownership by race. And I think it's probably, unfortunately, not a surprise that home ownership of Black families in Connecticut and in the US at large is much lower than their white counterparts. So the white home ownership rate in Connecticut hovers around 70, 72% versus just 40% for Black families in Connecticut. And those numbers match up pretty well with what we see on the national stage. And so it's not surprising when we flip to the next slide and we look at homeownership rates by zip code in Connecticut, that our cities, New Haven, Hartford, Waterbury, Bridgeport, these are areas with lower rates of homeownership. And if you take a look at where Connecticut's families of color live, predominant people of color living in cities, and the homeownership rates are lower there. Of course, that's not the only reason that we see homeownership rates lower in the cities. We also have to take a look at supply, where are single family or even 1 to 4 family homeownership options available. And as we'll see in further slides, there's an issue of supply in the cities as well. But really what this story of this slide is telling us is that homeownership is much greater in the suburban and rural areas in the state compared to our cities.
Kayla, can I just interject for a sec?
Yeah.
This slide and the previous one, Connecticut's rates of homeownership for Black households is lower than, and consistently lower than nationally. So what are some of the factors that might contribute to that?
I know, John and Andrew, if you'd like to pop in as well. So interestingly, the numbers that I have them like around the same, like that 40%. But as we see here, there is like, that little dip. And I think, partially, I think it has to do with the fact that, particularly in Connecticut, our families of color are predominantly located in the cities. And that is where we don't have a ton of home ownership supply. And John and Andrew, I don't know if you want to jump in as well.
Yeah, historically, when you look at sort of when, so when you look at, and we can spin a whole history lesson on this. So when you sort of look at the Great Migration of like Southern Blacks moving up north, this sort of coincided with the time where we saw lots of redlining happening in Connecticut. So many families who moved up north ended up moving into communities where that eventually became redlined and weren't really able to really have the ability to move into some of the newer single family housing stock that was eventually, developed in the 1940s and 50s. So I think we're living with sort of the legacy of that history. Again, not unique to Connecticut in any stretch of the imagination, but some of the current lack of new supply that's being built in Connecticut has probably resulted in some folks not being able to achieve home ownership. And we're later on, we'll be talking about sort of the increased price of housing in Connecticut over the last 2 years in particular, and how it just makes it that much harder for families to achieve home ownership, particularly families of color.
Yeah, and like John said, we could spend an entire session on this one graph itself, but I would just note that there's well-known wealth differences between Black and white households, unfortunately, and given that Connecticut's a much more expensive market than the U.S. at large, it kind of makes sense that you see that slight difference between the U.S. and Connecticut.
Thanks.
So just a quick summary on this first section. Connecticut has seen an uptick in new household formation, which is putting increased pressure on our already limited housing stock, which I know we're going to be discussing later on in the presentation. In addition, Connecticut is generally older than the U.S. at large. We saw on that graph more baby boomers and Gen X, less millennials, Gen Z, Gen Alpha. And roughly 2/3 of households in Connecticut are homeowners, and Connecticut appeared to purchase their first home around the age of 34, which is a couple of years younger than the US national average. And then, as we were just discussing, those homeownership rates are generally higher in suburban communities. So now we're going to shift gears a little bit and talk about the housing stock itself. So this is a big one. In Connecticut in particular, the median age of our housing stock is 56 years. Compare this to the national median age of about 44 years. Our housing stock is about 12 years older, as is the tale of the cities versus the suburbs. Our cities typically tend to be a lot older. The buildings in our cities tend to be a lot older than what we see in the more rural or suburban communities. You'll notice, in Hartford, New Haven, that median age of the housing stock really high up there, 83 years old. And that's going to continue to put pressure on a housing stock as we deal with issues of rehab and supply not meeting the demand necessary to accommodate all those new household formations. And so why is our housing stock, so old? One of the reasons is that Connecticut's rate of building has not kept up with the demand. So there's a couple of things I want to point out on this graph. We're looking at building permits sectored out by the size of the unit, so 1 unit, 2 unit, and then getting into our larger multifamily buildings. You'll notice in the late 80s a big drop off in construction in the state, the savings and loan crash that occurred at that time, and then a slow build back up. And then, of course, as we all remember, the Great Recession really caused us a plummeting in construction in the state, and we have just not seen the recovery in the state. In particular, Connecticut has not recovered well in terms of getting those number of building permits back online. So compared to 2005, which was the last peak on that graph for building permits, Connecticut has only recovered about 40%. This is compared to about 67% on the national average. And when we look at, some of our close neighbors, Massachusetts has recovered about 80% of that building activity, about 50% in Rhode Island. So Connecticut is still sort of lagging behind, particularly when we look at single family construction. We've done a little better looking at multifamily construction, 3+ units, but when we're looking at the single family starter home production, we haven't quite gotten back to where we have. And as you'll see, this is all going to have a snowballing effect on the situation that we're seeing now in the housing market. So this is an interesting graph, and it really drives home the age of Connecticut's housing stock. So what we're seeing here is the number of sales that have taken place since 2001, charted by the year of which the building that was purchased was constructed. And so you'll see, in the middle of that graph there, just, the really high number of sales. And what this is telling us is that a large amount of home sales are concentrated in the properties that, are between, 35 to 73 years old. Another interesting thing to note here is that there has been, a lot of sales of properties less than 1,500 square feet. So those starter homes, there is a demand for homes of that size. And because there have not been a lot of smaller homes constructed, in the more right-hand side of this graph, you look on that bottom x-axis, 2021, 2020, 2019, not seeing a lot of home sales of properties less than 1,500 square feet. And that, that has a lot to do with the lack of supply. So we talked a little bit about the lack of supply, particularly in our urban areas. And so this is taking a look at the one unit, so single family home ownership opportunity housing stock by zip code. And as you can see, we have a larger stock along that 91 corridor and in those suburban areas. But in our cities, the housing stock for home ownership opportunities is much smaller. It's really concentrated in the suburb, and this single family stock represents about 60% or so of Connecticut's total housing stock. If we look at the next slide, looking at the single family median home value, you'll notice that home values are pretty consistent across most of the state. Believe that the median home value is about $280,000 in Connecticut as of 2020. With, of course, the exception, as I'm sure many of us know, of Fairfield County, where we see much higher median home values. Taking a look at the housing stock of 2 to 4 family units, we see a sort of reversal of that first graph that we looked at of single family properties. Here, our 2 to 4 units are really concentrated in our cities and then a few key suburbs, once again, along that 91 corridor. And this 2 to 4 family structures represent about 16% or so of Connecticut's housing stock. This concentration in the cities becomes even more stark when we look at larger multifamily buildings of 5 or more units, and these make up about 18% of Connecticut's total housing stock. So a quick summary, Connecticut has an aging housing stock with significantly older stock in the major cities, and new housing construction really has not kept pace with the demand in the state. Our existing single family homes are generally located in the suburbs, while the multifamily stock is concentrated in our cities. And with the exception of Fairfield County, our home values are pretty consistent across the state. And now I think I'm going to be handing this over to Andrew.
Sure, thank you, Kayla. So now that Kayla's kind of laid the groundwork for some of the demographic and housing stock dynamics in the state of Connecticut, I'm going to briefly run through some of the trends we've been tracking over the course of the pandemic and also as a result of inflation in recent months. So what you're looking at here is just the number of home sales and the median sales price by year back to 2001. And it's really characterized by kind of a boom running up to the recession and then, bottoming out in roughly 2011, followed by a gradual increase in sales activity up until 2020, and then 2021 being the real outlier in overall sales activity. There were 61,000 home sales in 2021, and that's the most we've seen since about 2005. So basically in that run up to the Great Recession. You'll see 2022 is actually unfinished, given that we only have data through October, but we're imagining it'll be slightly less than what we saw in 2021, given kind of the cooling demand as interest rates increase. But 2021 was definitely an outlier amongst recent years, that's for sure. And then on the flip side, as a result of that increased demand and the onset of the pandemic, we saw the for sale inventory drop off dramatically after March of 2020. So in normal years, 2018, 2019, depending on the month you're looking at, Connecticut would normally have roughly 18,000 units for sale at any given time. But starting in March 2020, we didn't see that kind of seasonal spring, summer increase in inventory that we saw in previous years. And it really hasn't recovered really ever since, and it's been universal across all of Connecticut's markets. So in September of this year, we have about roughly 8 to 10,000 units for sale across the state. So we have generally about a third of what we would normally have during this time of year in kind of a normal pre-pandemic market. And you'll note that that blue bar there is that's the total inventory for the U.S. at large. So it's not a Connecticut specific phenomenon. It's happening across the country, and you can see that the U.S. has recovered really about half of the inventory that it had pre-pandemic. Connecticut's only about a third, so there's some indication that Connecticut's even a hotter market than the country overall. So with that decreasing inventory level, it gives sellers much more buyer power, much more bargaining power in sales transactions. So what we've seen as a result is the share of listings that's sold above their list price increased dramatically. So you see pre-pandemic anywhere between, or depending on the market you're looking at, roughly about 20% of listings would sell above what they were listed for. After March 2020, we saw that number increase to roughly 50, 60. And for instance, in Hartford earlier this year, that number approached 80% of listings selling above their list price. The good news is you can see, things appear to be rolling over, coming back down. The question is whether that's just seasonality or whether we're going to see that, seasonal increase in inventory push this number back down to where it should be. Another dynamic we've been tracking is days on market. So we've seen homes just sell much faster than they were historically. So this is the average number of days a home is listed until pending, and it's indexed to where it was in March of 2018. That's just to account for differences across different markets and standardize things. But you can see across every market in the state and in the U.S., homes are generally selling about twice as fast as they normally would during pre-pandemic times.
Andrew, if I could interject a question. From the previous slide, if we look at the 2021 sales kind of spike there, is there, do you know what the breakdown of some of that spike might have been in terms of were new buyers, existing Connecticut residents, for like folks coming in from the state, the conversations about folks from New York City moving into Connecticut. How do we have a sense of what that breakdown might have been?
Unfortunately, from this data, we don't. It's basically just a transaction level. We don't have any information on the buyer per se. We'll get into some more buyer characteristics in a bit, but I think we've all anecdotally heard of the stories of New York buyers coming in, or folks from other state coming in with buying cash. John, feel free to jump in here, but right around the onset of the pandemic last year, we actually saw the number of cash buys exceed the number of buys with a mortgage. It was about April and May of 2020. So there's some indication that it might be some wealthier folks coming from out of state buying up a property with all cash. But again, that's just kind of, it's guessing more or less.
Thanks.
I think most of the stuff is anecdotal at this point. But I think once we get a little bit more, once the American Community Survey catches up, and then we'll also have data from the Home Mortgage Disclosure Act, HMDA, which is lending information. With the HMDA, we can see if folks are getting mortgages for the purpose of owner occupancy. So if we see that go down, then we'll have a better sense if folks are purchasing a second home or not. But the data unfortunately, throughout the whole pandemic, data lags. So we're playing a little catch up right now and sort of making some assumptions based on various different data sets and what stories they may be telling.
So, kind of it's a combination of lack of inventory leading to increasing in bidding, increasing in prices. Homes are moving much faster. So even before the interest rate increases we were seeing over the last couple of months, home buyers are being priced out just based on kind of market dynamics, by competition, by prices. With what the Fed has been doing to combat inflation recently, it's compounded the affordability challenges for first-time and existing home buyers. So now you can see here, this is the average 30-year fixed rate in green, with the year-over-year change in that rate in the blue line. And you can see that 7%, 6-7% mortgage rates aren't historically abnormal, but what is abnormal is the rate at which we've seen these increases over the last month. Between earlier this year and now, we've seen the largest year-over-year increase we've seen since roughly 1981. So it's been a rapid increase, and we haven't seen the what we normally see if rates increases would be price cooling down, inventory coming back online. So it's really now that folks are being priced out just based on the monthly payment alone. So Kayla, John, and I were on a webinar pretty recently with some housing economists from Harvard, and they just mentioned that their estimates point to a 50% reduction in the pool of potential first-time home buyers, just based on the interest rate increases alone. So, it's if you're an active home buyer, it's a really, really tough market out there at the moment. So we also just wanted to comment on, anecdotally, folks may have been hearing about increased investor activity in Connecticut and in some markets, and that is definitely true when you drill down to specific markets. But you can see here at the state level, we haven't really seen an overall increase in investor activity as a percent of total sales. So it's depending on the year you're looking at. Investor activity generally hovers between 15 to 25% of the market. Just for FYI, we classify in our sales file an investor as anyone that appears with the name in their name with an LP, LLC, incorporated, things like that, kind of keywords, but also folks that appear multiple times during a certain time period. So then on the lending side of things, John mentioned the Home Mortgage Disclosure Act data. That is basically the federal anti-redlining law. It requires lending institutions to submit data to regulators on pretty much all of their lending transactions. And you can see this is that data back to 2007 by loan purpose. So home purchase, refis, and home improvement. And you can see kind of the dip in blue in home purchases from the recession down to 2011 bottoming out, and then the general recovery in home purchases. And then refis were really prevalent between really 2007 and 2013 when rates were were decreasing. And then again, as might have noticed from the rest of these slides, 2020 is really the outlier here. You see a dramatic increase in both home purchase loans originated, but also refinance applications as rates were really at all-time historic lows. The other thing that the data lets us do is look at denial reasons by year for home purchase applications, and you can see denial reasons are pretty consistent year to year in Connecticut. The primary three are credit history, debt to income, and collateral, which is basically the appraisal gap. Basically the home not being worth what folks think it is. So I realize that was a lot of kind of bad news, doom and gloom. The one kind of bright spot in the market is among existing homeowners. So this is looking at the overall delinquency rate and then the foreclosure rate back to 1990 or 1999. And you can see kind of the run up in delinquency rates leading up to the financial crisis and Great Recession, general recovery, and then the dramatic spike in delinquency rates with the onset of the pandemic, and just rapid recovery thereafter as folks work things out with their servicer, either sold if they really got in trouble or took advantage of other resources. And as of September of this year, Connecticut's overall delinquency rate is about 2.9, and that's the lowest we've seen since 2007. We haven't obviously seen the run up in foreclosures yet, but we really doubt we're going to see something similar to what we did during roughly 2010, 2012, that time. So delinquency rates are low, but also, I also pulled this from CoreLogic the other day, and we don't have it here, unfortunately. So only about 60% of homeowners in the state have a mortgage. About 30% or about a third have paid it off or bought in cash, as we discussed earlier. But amongst that folks that do have a mortgage, 71% of them have rates under 4%. So delinquency rates are good there, and their monthly payments are affordable. So if you took advantage of the market over the last couple of years, and refied, you're in a good spot. You have affordable payment, credit profile is pretty good, and you're not really at risk unless job losses start to pick up of delinquency. So just to summarize, that was kind of a lot. So Connecticut's seen a rebound in both sales volume and median sales price since the financial crisis. More recently, inventory shortages, increased competition, increasing home values are creating a very difficult market for first-time home buyers and existing home buyers. Interest rates have increased rapidly as the Fed attempts to counter inflation, creating further affordability challenges for home buyers. And then according to the most recent HMDA data, Connecticut saw a significant increase in lending activity in 2020, driven by both home purchases and refinance applications. And I should also mention we don't have 2021 data just yet. We imagine it looks very similar to 2020. So just another year of high demand, and high originations. Then traditionally, the primary loan application denial reasons are debt to income, credit history, and collateral. And then over the course of the pandemic, mortgage delinquency rates spiked and then quickly recovered to pre-pandemic and even pre-financial crisis levels. So with that, I'm going to hand it off to John, who's going to talk about how these dynamics interplay with the rental side of things.
Yeah, so thanks, Andrew and Kayla. Awesome. So yes, I'll talk a little bit about the rental market, and this will probably all sound very familiar. I think it's really important to note that the dynamics of what's happening in the single-family home ownership market have some real impacts on the rental market as well. They sort of impact each other in ways that folks sometimes forget. So again, this isn't a surprise based on what Kayla said. When you look at sort of what type of stock is where in the state, most of our renters are located primarily in the urban core, or at least maybe first-ring suburbs. So your Hartfords, New Havens, Middletown, even Manchester tend to have most of the rental units across the state. Again, not a surprise at all. This is all just sound very familiar. So vacancy and affordability, vacancy rates are down, and affordability becomes tougher when you have lower vacancy rates. So here's a great chart looking at the vacancy rate both by the market rate units. So these are units that are not restricted or not generally government subsidized, compared to those that are government subsidized. And there's a need for both. Vacancy rates have dropped over the last few years. And as you can see, even amongst affordable units, again, this is statewide, you're seeing vacancy rates below 2%. So not much in the way of available units for those looking to rent.
John, can you just quickly
Sure.
talk about what a healthy vacancy rate looks like in markets?
Yeah, that's a good question. I think it depends on the market, but when you're looking at 2% vacancy rates or even anything below 4%, it does give there's just tightness in the market. It's a simple supply and demand issue, right? So oftentimes there are landlords who take advantage of this, obviously, and may look to increase their rents. But there's also a dynamic that happens when it comes to the amount of folks looking to rent a home, and it just drives prices up. So I don't want to necessarily say what's a healthy vacancy rate depending on the market, but these are some of the lowest vacancy rates we've seen in a long time, and by some accounts, some of the lowest vacancy rates across the country, particularly when you get down to sort of the Gold Coast of the state, and even New London County in particular, and we'll go through that. So Andrew, perfect. So the vacancy rate, when you look at certain markets now, these are markets, these aren't necessarily cities. So you're looking at the Hartford MSA, which includes Hartford, Tolland County, Middlesex County, New Haven, which is New Haven County, Norwich, which would be New London County as a whole, and then Stamford, which is Fairfield County as a whole. And you can see vacancy rates just started dropping right at really at the end of 2019. So even as the pandemic really was not even necessarily most folks' radar, and then in 2020 you saw this drop in the number of drop in number of vacancies. I think what's particularly interesting is to see sort of New London County going from probably one of the higher vacancy rates in the state to going down to some of the lowest, having the lowest vacancy rates in the state. And I think it's a combination of the fact that New London County was generally the more affordable rental market in the state. And in addition, there has been some real economic activity in New London County, which has, again, driven probably increased demand. And when you don't have many units to begin with, it can really play havoc on vacancy and rents. Here we have sort of year-over-year changes of rent growth. And again, you can see that, again, with the onset of the pandemic, you saw prices go up. And particularly in sort of New London County, we saw that spike. And again, I think that's mostly driven by the fact that New London County has historically had has had a more affordable rental market than, let's say, than most of the other metros. In addition, we have seen economic activity in New London, which is awesome, but that just, again, places pressure on what the available housing stock that's there.
Really quick, John, I just wanted to note the forecast there. So I don't really claim to have a crystal ball or anything, but given how much of the kind of inflation metrics are made up by the cost of shelter, the cost of rent, you see that forecast with things returning to some sense of normalcy. This is some indication that in the future, the Fed is going to see this and say, okay, maybe we can take the brake off the gas pedal per se, and interest rate hikes that might lead to a bit more of an affordable market. Inventory might start coming back online. Cross fingers, but that's kind of the avenue out of the crazy competitive market we're seeing right now.
Yeah, exactly. And I wanted to sort of, again, go back to something that Kayla had mentioned earlier. So while the state hasn't seen this increase in population over the last few years, we have seen an increase in the number of households. So again, households are getting smaller. Folks are graduating college or moving out of their parents' home, and that constitute a new household formation. And so while we're not seeing population growth, we are seeing households growth, which again adds pressure to the market. So these are the households that are occupying what was vacant units prior to them becoming households. And with that being said, with home prices going up on the homeownership side, there are lots of folks who are potentially delaying home ownership because they either don't have the funds or the means to be homeowners, or they're waiting for the market to cool off, or they've been locked in, or they now are no longer able to get a mortgage, or they're no longer able to afford a mortgage due to the increase in interest rates. So there's just a lot of dynamics happening in the market that is tightening the rental market, squeezing the rental market and making vacancies go down. Next slide. So here we have sort of the producer price index by commodity. So this is cost of construction materials, and we've heard this. I think most folks have heard this either through the news or anecdotally. We're seeing construction costs go up as with supply chain issues, again with the issues of COVID. So even the building of new units is cost a lot more. So here we have new demand for housing in the state, or increased demand for housing in the state over the last couple of years. And it sort of coincides with the fact that construction costs are going up, which then makes building new housing stock even more difficult to do and more costly. With that being said, there have been rental units that have been put onto the market. So we look at CoStar data, which is a great resource. They provide a lot of data when it comes to units being put on the market, vacancy rates. They own apartments.com. So this is how we get a lot of sort of the information when it comes to available rental units and so on and so forth. But you can see that over the last number of years, most of the units that have been delivered are are coming out of either the Fairfield County, which makes sense. That seems to be where the most demand's coming, and sort of fits into the narrative that there are folks who are potentially moving from New York or the New York metro area and moving to the Gold Coast. But we are seeing units being delivered in New Haven, which has become another rental market that's seen increased demand. And Hartford we've seen units being delivered in Hartford. Norwich is lagging in this, but I know there are units in the pipeline. So affordability restricted, I had mentioned this earlier, and I saw there was a question regarding this. So when we look at when we look through the National Housing Preservation Database, essentially it's a database of all government assisted housing, and they monitor affordability or the expiration affordability is based on the expiration of the subsidy that's been placed on the development. So for example, for the low income housing tax credit, if that was the only government subsidy on the project, they look at to see when the expiration date for that affordability comes up, and they count that as the date that those units can expire from being affordable. And most of those units, not surprisingly, are located in our urban core. Again, as I alluded to earlier, we can do a whole history of why most of these units are located in urban cores, but this is where we're seeing the most potential for expiring units. Many of these cities also have naturally affordable units as well. It doesn't mean, though, that these units aren't important. In fact, should be looked at for preservation, but most of those units are mostly in our urban centers and first ring suburbs. But again, this is where most of the rental stock is available, and this is where most of the government assisted housing has been built and subsidized. And so some of the key takeaways, again, it sort of fits in with what you've heard from Andrew on the single family housing front, and Kayla on sort of what the stock of housing looks like in the state and demographics. Renters are generally concentrated in, or found in our major cities. Again, this is where the housing stock exists. It's an older housing stock. I think by some estimates, I've seen the median age of the housing stock in our cities to be north of 85, I think, years old. So we're talking about a much older housing stock, but that's, again, when multifamily housing, particularly smaller multifamily housing, was built through the state. So that's where you see most of those units. Over the course of the pandemic, and again, potentially, due to the sort of the hot, single family market, we're seeing vacancies in the rental market drop. Again, we're seeing that increase in a number of households in the state who are looking to rent or purchase their first home, but because of the lack of supply in the homeownership market, folks are renting because they're waiting either for the market to cool off, or there are just no available units. I'm sure a number of us have heard stories about folks not being able to find a home, or they found a home and they were scooped up right away, and that has impacts on the rental market. And then finally, Connecticut is seeing a number of units expire over the next decade. Many of these units are used various different kinds of subsidy. I know the state Department of Housing, Connecticut Housing Finance Authority keeps tabs on this and looks to work with property owners and developers and nonprofits to try to preserve these units for the foreseeable future. But there are a number of units that are up for affordable expiration in the next decade. So it's something that I think we as a state need to sort of keep our eyes on. And again, most of these are located in urban centers, and I know there's definitely a need for more affordable rental units, in particular in areas with more resources. So this is the dynamic in the affordable housing market as we see it today. So with that said, I think I'll pass it on to Kayla, who will tell you about some of our resources.
Great. So before we get to questions, which I've seen a lot of great ones come through the chat, we just wanted to give you a couple ways to stay in touch. The first is if you love the contents of this presentation and you want to learn more and keep up with things as time goes on, please check out CHFA's blog, The Intersect. We author a quarterly housing market rundown, so you can keep up to date on all of the different metrics that we've talked about here today. So please visit us there. Please stay in touch with us by signing up for our email notifications. And if you have questions or follow-ups from today's presentation, you can reach John, Andrew, and I at research@chfa.org. And definitely follow us on our social medias, because we're very active there as well.
Thanks, Kayla. There are a lot of great questions and comments in the chat, and we have at most 9 minutes left, so I don't think we'll get to all of them, but as Kayla mentioned, please follow up with this great team. There's some great questions that we'll try to get through as many as possible. There's a question, can you go back to the last screen so folks could see the comment? Thank you. So I guess first, just to go back to the rental market and vacancies. There are several questions about vacancies, how vacancy rates are calculated, how they're measured, both in homeownership and the rental market. And just maybe more an explanation of why zero vacancies is not what are the consequences of getting a very low vacancy rate or approaching zero, and in other words, why are there vacant units in what some might call a healthy market? And kind of tied to that, there's a great question from our friend Fran Martin about new or refined policy or program efforts that CHFA is considering to respond to some of these market gaps and needs. And if there's anything you can speak to on that.
So I can speak to a little bit on the vacancy rate and how the low vacancy rates that we're seeing is affecting the market. So there's a couple of things going on, and I think it's important to remember that the single family homeownership market and the rental market, they don't exist in a silo. The things that are happening in one market are affecting the other. So that very first slide that we showed as we started our presentation showed this increase in households, right? That means more people need more units. And so that occurs right on the homeownership and the multifamily, the rental side. So as COVID hit and we started to see this increased demand to own a home, to get a private space of your own, maybe move out of an apartment building to somewhere with more space, we started to see that the prices there go up. And not just because of COVID, but as we saw, inventory of single family homes was going down. There was no new construction. So there was a lot of competitiveness in that single family market, making it very hard to buy a home. We saw multiple offer situations, cash buyers, as people mentioned. And so that affected the rental market, because people, especially, around age 33, 34, when typically we see homeownership come about in Connecticut, the market was so competitive that many of the people who may have moved out of their rental into a homeownership situation could no longer afford to do so. And so the natural churn in the market, where normally we would see people move from a rental situation to homeownership, making room for this, new generation of renters to come in, that didn't occur. Instead, we saw vacancy rates, really plummet, both on the inventory for homeownership and on that rental market, because people were staying put. They couldn't afford to move into a homeownership situation. And when you have vacancy rates driven down, right, there's only a few apartments available, in any given area. And unfortunately, that puts a pressure on the market, and rents are raised at that time, because it's a supply and demand issue. The more demand you have, the smaller amount of supply, it drives up the rents. And so that's really the situation that we've seen the last couple of years. And fortunately, as Andrew mentioned, when we were looking at the projection side, we do anticipate over the next few years a smoothing out of that rental market as things come back into balance. It's just a prediction, of course. We can't, we don't have our crystal ball necessarily, but hoping that the market smooths out a little bit so that some of those renters can move out of a rental into a homeownership situation.
Can I, we may only have time for one more question, maybe two. There are a few questions related to the expiration of affordable homes and what the state can do about it. What are the consequences of those expirations for the affordable housing supply? So I don't know, that's the question. What can the state do further?
Yeah, I think, I don't want to speak on behalf of Department of Housing or others, but I think the reality is that the state is doing stuff. as part of its funding. Part of its funding, it does prioritize sort of the rehab through rehab of some of these older units. Again, some of these units are older, so they require some rehab. So units come in, they get dollars for rehabilitation, and they extend the affordability period for those units. A number of the projects, one of the things that number is a very scary number, but there's also some folks need to realize that some of those units are also owned and managed by nonprofits with affordable housing missions. So while it may look like their affordability is going to expire soon, those are projects are owned by again by nonprofits who have a mission to preserve affordable housing and will likely extend affordability probably through looking for additional federal or state dollars to rehab some of these projects. Again, a lot of this housing stock is older, so it needs some TLC. So I'm confident that things will be done to help preserve as much of the units as possible. And then again, I think with the amount of resources the state does have, there is a push to build new units in higher resource communities. I know the partnership has talked a lot about this in the past, and so have our partners at the Connecticut Housing Center and Open Communities Alliance, that we need more affordability in communities that don't have any or very little income restricted housing. So it's a combination of preserving what can be preserved and building new in areas where folks may want to move to. So I think it's finding that balance that's tough. And it's, you know, the other thing too, on the homeownership side, I just want to touch base on that. You know, it's a tougher nut to crack. Starter homes can be difficult to build for various reasons. I know that the Department of Housing has, and, you know, CHFA sort of helped administer the program, but the time to own program, which has exhausted its dollars, but looking to get more dollars, has helped a lot of homeowners afford down payment to purchase their first home throughout the state. So I think there's just resources out there to help folks, again, purchase their first home and try to preserve the units. But it's tough. There are a lot of units out there, and it's going to take some brainstorming for sure.
Thanks, John. And I think we're going to wrap there, but there have been a couple of requests for the PowerPoint. So if we can share that, that would be great. And I can make sure that gets out. I just want to answer from an advocacy perspective, the idea that we have all these expiring affordable homes, the risk to that, the desire to expand the supply of housing. The state of Connecticut has devoted many hundreds of dollars, millions of dollars, more than hundreds of dollars, over the years towards affordable housing construction and redevelopment, rehabilitation. We need more of that. And so if you're concerned about these things, that's one thing the state can do, is increase the levels of investment available to the Department of Housing to preserve and expand affordable housing. Thanks. Next session is Building Wealth and Equity in Communities Through Homeownership. Begins at 11:30. Thank you, everyone.
Thank you. Have a
Thank
good
you
one.
very much.
Thank you very much.
Enjoy the conference.